If you've ever looked at your investment account and thought, is this seriously it? After all this saving, this video is for you. We're told that compound interest is the eighth wonder of the world, that long-term investing is the secret to financial freedom. But when you actually do it in real life, it feels slow, boring, and sometimes pointless. Meanwhile, it looks like everyone else is getting rich overnight with crypto, stock tips, and passive income hacks. The truth is, most people don't fail because compound interest doesn't work. They fail because there's a compound interest trap that makes patience feel almost impossible. In this video, I'll break down 3 psychological traps that quietly destroy decades of growth, how to survive the silent years where nothing seems to happen, and how to think like the tiny minority who actually make long-term investing work. If you care about building wealth like a calm, rational adult, using simple strategies like index funds, dollar-cost averaging, and real retirement planning, subscribe to Trip to Wealth right now so you don't miss the rest of this series. Most people think compound interest is a math topic. If I just understand the formula or find the right investment, I'll be fine. But the math is not the problem. The hard part is surviving the emotional experience of compound interest in real time. On a spreadsheet, long-term investing looks beautiful. The line curves upward, the numbers become huge. Financial independence looks inevitable. But in real life, the first 5-10 years often feel underwhelming. You're putting hundreds, maybe thousands, into retirement accounts, index funds, or ETFs every month. You're doing what every investing for beginners guide tells you. And yet, the balance still looks small compared to the effort and sacrifice. Your brain hates this. We're wired for quick feedback. Work equals reward. Effort equals visible progress. Compound interest refuses to play that game. It hides the real payoff in the future and gives you almost nothing emotionally today. So what happens? People don't say, my psychology is struggling. They say, investing doesn't work, or the stock market is rigged, or I need a better strategy. They change the plan, reset the clock, and start again, never staying invested long enough for the curve to finally bend. The math of compound interest works. The question is whether your behavior will let it. The first big compound interest trap is comparison. Imagine you're doing everything right. You've set up automatic investing into low-cost index funds. You're using dollar-cost averaging. You're focused on long-term wealth building and retirement planning. It's not exciting, but it's working. Then your friend tells you they tripled their money in crypto. Someone at work is day trading options and posting huge wins. Your YouTube feed is full of people claiming $10,000 a month passive income from some new strategy. Suddenly, your calm, boring plan feels stupid. Your 7 to 10% annual return looks embarrassing next to someone else's lucky week. What you don't see are the hidden losses, the blown-up accounts, the sleepless nights. Social media is a highlight reel of outliers, not a realistic picture of long-term investing. But your brain doesn't care. It just feels left behind. So you do what most people do. You chase. You pause your normal contributions, sell your boring investments, and jump into whatever's hot. And the moment you do that, you reset the compound interest clock. You stop your own exponential curve and start again from zero somewhere else. The comparison trap doesn't just make you feel bad. It quietly steals the one thing compounding needs most: uninterrupted time. Every strategy hop is another decade of lost potential hidden in a single emotional decision. The second trap appears the first time your portfolio takes a real hit. Maybe the stock market drops 20%. Your retirement account is suddenly down 5 figures. Logically, you've heard markets recover, stay the course, time in the market beats timing the market. Emotionally, it feels like your future is being erased in real time. This is loss aversion in action. Research shows that losses feel about twice as painful as equivalent gains feel good. Earning $10,000 slowly feels nice. Losing $10,000 quickly feels like a crisis. So when you see red in your brokerage account, your brain treats it like a threat to your survival, even though it's just volatility. This is where many people abandon long-term investing. They sell their index funds or ETFs, move to cash until things calm down, and swear they'll get back in later. They don't realize they've just paid a massive price. They locked in losses and missed the eventual recovery, exactly the period where compound interest and market rebounds do some of their best work. The paradox is this: the crashes you fear are also the moments that transfer wealth from impatient investors to patient ones. Volatility is not a bug in the system. It's the entrance fee to long-term returns. The trap is treating temporary drops like permanent failure instead of a normal, necessary part of wealth building. The third compound interest trap is subtler but deadly: the slow progress illusion. This usually hits in years 3 to 7 of your investing journey. You've been consistent. You invest every month. You're using a simple, diversified strategy, maybe broad market index funds inside a retirement account. You're doing textbook long-term investing, but when you look at the total, it still feels small. You expected exponential growth to feel like a rocket. Instead, it feels like a slow walk. And your brain, which thinks in straight lines, quietly decides, this isn't worth it. I'm sacrificing now and getting almost nothing back. Here's what's actually happening. In the early years, most of your portfolio growth comes from your contributions, not from compound interest. You're still building the base. The curved part of the graph, the part where growth from investments outpaces your new contributions, comes later. But you have to survive the flat-looking years to get there. The slow progress illusion convinces people to stop right before the curve inflects. They change strategies, cash out to buy something, or take a break from investing. They never make it to the crossover point where compound interest finally starts to feel powerful. If you're in that phase now, it doesn't mean your plan is failing. It means you're earlier in the story than your emotions want you to be. Let's talk about the moment everything changes, the compound interest crossover point. This is when your investments start working harder than you do. At the beginning, almost all of the growth in your portfolio comes from your own contributions. If you're investing $500 a month and your portfolio grows by $6,000 in a year, that's basically just you working and depositing. Compounding hasn't really woken up yet. But over time, especially with consistent long-term investing in diversified index funds or ETFs, something flips. There comes a year where the growth from your investments is bigger than the amount you put in. Maybe you contribute $6,000 in a year, but your portfolio grows by $8,000 or $10,000. That's the crossover. That's compound interest finally taking the lead. Emotionally, this is huge. Investing stops feeling like I'm sacrificing now for a future that may or may not show up, and starts feeling like my money is actually working for me. This is the stage where people begin to feel genuine momentum toward financial freedom and retirement. The tragic part? Most people never reach this point because they fell for one of the 3 traps earlier: comparison, volatility panic, or the slow progress illusion. Your real job as an investor is not to find the perfect product. Your real job is to stay alive, financially and emotionally, long enough to reach and then live in this crossover zone. To escape the compound interest trap, you need a different identity. Not the smartest investor, but the longest-lasting investor. There are 2 main characters in this story. The first is the outcome chaser. They judge their plan by 3 to 6 month results. If markets are up, they're a genius. If markets are down, the strategy must be wrong. They switch funds, strategies, or asset classes every time something feels uncomfortable. Their time horizon is always shrinking. The second is the patience investor. They judge their plan by contributions and years in the market, not by last quarter's returns. They understand that real wealth building happens over decades, not weeks. They measure progress by, did I invest this month, and am I sticking to my allocation? Their edge is not insider information or perfect timing. Their edge is emotional endurance. Here's a powerful reframe. Every time the stock market crashes, wealth doesn't disappear. It changes owners. Impatient investors hand future returns to patient investors at a discount. When you sell in fear, you're not avoiding pain. You're donating long-term gains to someone who can sit in discomfort. So your core belief needs to shift from "I win by picking right" to "I win by outlasting the majority." At 40, 45, or 50 with a mortgage and kids, your advantage is not speed. It's the ability to behave like a calm adult while everyone else reacts like a trader. You can't rely on willpower to beat these traps. You need a system that makes patience easier and emotional reactions harder. Start with pre-written rules. Before the next market drop, decide in writing what you will and won't do. For example, if my portfolio falls 20%, I will not sell my index funds. I will continue my monthly contributions. I will only rebalance if my allocation drifts more than X%. When panic hits, you follow the rules you wrote with a clear mind. Next, track what you can control. Contributions, not daily value. Instead of obsessively checking your brokerage account, track how many months in a row have I invested. This keeps your brain focused on behavior, not noise. Then limit portfolio checking. For long-term investing, most people don't need to look daily or even weekly. Setting a schedule, like once a month, reduces the emotional roller coaster. And to make any investment process easier, we are building the Trip2 Wealth Command Center, a Google Sheet system that tracks your income, spending, investing, and net worth in one place. It acts as a strategy hub that reveals money leaks, growth opportunities, and how small changes compound. Join the early access list below. The tool will be out soon. A patient system doesn't remove uncertainty, but it gives you structure. It turns "I hope I don't panic next time" into "I know exactly how I'll behave when the next test comes." Let's bring this together. Compound interest is not failing you. Your brain is just not designed for the way it works. The trap is the gap between how fast we expect progress to feel and how slowly wealth building actually shows up in real life. You saw 3 major traps: comparison, the illusion that everyone else is getting rich faster; volatility panic, the urge to escape when your screen turns red; and the slow progress illusion, the feeling a few years in that all your effort is barely moving the needle. Any one of these can reset decades of potential in a single decision. But you also saw the path out. Understand the crossover point where growth from your investments finally outpaces your contributions. Shift your identity from outcome chaser to patience investor. And build a personal system that automates good behavior and protects you from yourself. If you're somewhere in the silent phase right now, investing steadily, not seeing much yet, that doesn't mean you're failing. It often means you're closer to the crossover than you realize. Your job is to stay in the game long enough for compound interest to finally show you what it can do. If this helps, make sure you watch my video on the 10-year compounding rule next. It's the full roadmap for surviving the years when everyone else quietly quits. Remember, this video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. Always assess your risk tolerance and investment goals before allocating your capital. Don't forget to like, share, and subscribe to our channel. Also, feel free to leave your comment below, especially if this video made you think differently. I appreciate your support more than you know. Until next time, stay consistent, stay patient, and stay winning. See you in the next one, Money Magician.